In today's digital age, the way people handle their money is changing rapidly. For many years, commercial bank has been the main choice for financial service like saving money, taking out loans or paying bills. These banks are well established and are trusted by the public because of their long history and strong government regulation. People are used to going to physical branches to get help with their money matters. However, now we see the rise of FINTECH companies, also known as financial technology firms. These are modern business that use technology such as mobile app and websites to provide fast and convenient financial service. Example includes e-wallets like Touch 'n Go and Shopee Pay, which allow users to pay for things, transfer money, or manage their finance from anywhere using just a phone. FinTech has become especially popular with young people because it is simple, quick, and easy to use. As a result, a strong competition has formed between banks and FinTech. It's trying to attract more users and improve their service. Banks are now upgrading the digital system, while FinTech companies are expanding their service to include things like loan and investment. This growing rivalry is not just about business, it's about shaping the future of how we manage money. Understanding the strengths and weakness of both sides will help us see who might lead the future of banking or whether they will work together to serve us better.
Assalamualaikum, my name is Ahmad Fidaus bin Abdul Hadi and I'll be presenting about the roles of bank in monetary policy. So the first role is act as a transmission mechanism in monetary policy. Interest rate policy. Central bank will adjust the interest rate which will be followed by the commercial banks. In terms of reserve requirements, central bank will set the minimum reserve requirement commercial bank must maintain. Next, open market operation. Central banks buy or sell government securities to commercial banks and they manage supply and influence the interest rate. Next, financial intermediaries. Banks accept deposits from individuals or businesses and provide a safe place for them to store their funds. The funds then used to provide loans and credits to borrowers.
Today I want to discuss about the role of central banks in the future of digital finance. The global financial system is undergoing a rapid transformation fueled by technological innovations. Digital finance, including digital payments, cryptocurrencies, decentralized finance, and fintech services, is fundamentally changing how value is stored, transferred, and managed worldwide. In response, central banks are adapting their roles to maintain monetary stability by addressing the effects of digital assets on inflation, money supply, and interest rate. A key initiative is the development of central banks' digital currencies, which are secured government-issued digital currencies designed to improve payment efficiency, enhance financial inclusion, and preserve monetary sovereignty in an increasingly digital economy. Beyond issuing digital currencies, central banks are also focused on regulating the expanding digital finance landscape by overseeing cryptocurrency markets, stablecoins, and DeFi platforms to protect consumers and the overall financial system from systemic risk. They are upgrading financial infrastructure by promoting real-time payments, open banking, and interoperability with fintech platforms to create a seamless financial ecosystem. Additionally, central banks support financial inclusion through digital ID systems and mobile banking, particularly for underserved populations. To safeguard this evolving system, they lead efforts to strengthen cybersecurity, set reliance standards, and coordinate crisis responses. Finally, recognizing the global nature of digital finance, central banks foster international cooperation to align cross-border regulations on CBDC, anti-money laundering, counter-terrorism financing, and data privacy with key global institutions. Thank you. Today I want to talk about FinTech's roles in financial system. FinTech or financial technology plays a transformative role in modernizing the financial system by leveraging innovations like mobile apps, artificial intelligence, blockchains, and big data. These technologies make financial services such as banking, payments, lending, investing, and insurance more accessible, faster, affordable, and user-friendly. One of FinTech's most powerful impacts is expanding financial inclusion. It provides access to banking and credit for unbanked and undeserved population through mobile platforms and digital solutions, helping close long-standing gaps in financial accessibility. Beyond inclusion, fintech drives innovation and efficiency by automating financial process, reducing transaction costs and enabling faster service delivery. It enhances the customer experience by offering personalized financial solutions through AI and advanced data analytics. Fintech firms also collaborate with traditional banks, helping them modernize outdated systems and reach new customers while encouraging healthy competition in the financial sector. However, this rapid evolution introduces new challenges, particularly in data privacy, cybersecurity, and regulation. As fintech continues to grow, it supports economic development by improving access to credit, fostering entrepreneurship, and fueling small business growth, making it a crucial force in the future of finance. Thank you.
FinTech can influence both positive and negative impact on monetary policy. Therefore, I would like to highlight four specific impacts, the two positive and the two negative impacts on monetary policy. Firstly, FinTech can bring positive impact on monetary policy to enhance monetary policy transmission. A major benefit of FinTech lies in its capacity to enhance the speed and reach of monetary policy transmission. Traditional policy transmission relies on the commercial bank as intermediaries to translate central bank action into real-world effect on consumers and business. However, FinTech platform bypass traditional banking channel, offering a faster and more adaptive lending, investments, and payment mechanism. For instance, in the United States, the Lending Club, a major peer-to-peer lending platform, adjusts its lending rate dynamically based on the Federal Reserve interest rate decision. This allows fintech borrowers to experience the impact of monetary policy almost in real time, especially compared to the conventional banking, which may adjust more slowly due to bureaucratic delays. Next, fintechs also can improve financial inclusion. Fintech has played a crucial role in expanding access to financial services, particularly among populations that have been historically excluded from traditional banking. Mobile payment system, digital wallets, and microcredit platform have been made banking services accessible to rural and the low-income population, thereby broadening the monetary policy base. For example, in Kenya, M-Pesa, a mobile money platform, has brought millions of previously unbanked individuals into the financial system. This inclusion has strengthened the central bank's ability to influence the consumption patterns and savings behavior through interest rate adjustment. However, fintech can also bring negative impacts on monetary policy. Firstly, fintech can weaken the central bank control over money supply. Fintech innovation, particularly decentralized finance, stablecoin, and cryptocurrency, pose a challenge to the central bank traditional control over the money supply and monetary aggregate. This private financial system operate beyond national monetary framework, making it difficult for central bank to monitor or influence them. According to the Muntaz and Smith, show that fintech adoption weakens the relationship between traditional monetary indicators and money demand, while Vujovic state that in developing countries, digital money operated by mobile networks can function as a shadow currency, further diluting central bank influence. Last but not least, the second negative impact is increased financial volatility and systematic risk. Fintech rapids often unregulated expansion creates new challenge of financial stability, especially through unsecured lending and speculative instruments. Many fintech platforms are not subject to the same risk management standard as traditional banks, increasing the likelihood of credit bubbles and systematic failures. According to the Cornell, he observed that fintech credit respond less predictably to monetary policy compared to the bank credit, making it more challenging for central bank to curb access credit. He also further warned that fintech's decentralized and opaque lending model increase the risk of uncontrolled credit expansion, especially in economics with weak financial oversight.
Now, let's look at comparative analysis, banks versus fintech. Banks collect deposit and issue loans using their own balance sheet. They assume the credit risk and earn profits from the difference in interest rates. Their structure is centralized, heavily regulated, and often hard to enter due to high requirements. On the other hand, fintech use technology to directly connect users like borrowers and lenders through digital platforms. They do not hold deposits or assume credit risk. Instead, they earn through fee and service charges. This decentralized model allows for faster and more flexible financial services like digital wallets or mobile app payment. Banks are traditional intermediaries. They hold funds, evaluate borrower risk, and manage liquidity using structured models. In this centralized structure, the bank stands between the saver and the borrower, and strict regulation ensures system stability. Fintechs, by contrast, disrupts this by using platforms to directly match users. For example, in peer-to-peer lending, Fintechs don't lend money, they connect people. This reduces overhead but also removes some safeguards, shifting responsibility and risk towards users and algorithms instead of institutions. Now let's look deeper into how commercial banks and fintechs make money and manage their costs. Commercial banks primarily generate revenue from the interest margin. That is the difference between what they earn from loans and what they pay on deposits. They also earn from service charges like ATM or overdraft fees. However, their operation involve high fixed costs, maintaining physical branches, paying staff, and meeting strict regulatory and capital requirements. Fintechs, by contrast, follow a tech-driven model. They earn through digital transaction fees, subscription, or commissions. Because they operate mostly online, they have lower overhead, but they spend significantly on technology development, cybersecurity, and marketing to scale and compete. In summary, banks are more stable and infrastructure heavy, while fintechs are more flexible, scalable, and data driven, but also more exposed to tech and market risk. When comparing their business models, four main points stands out. First, credit allocation. Banks use credit history and former employment data. Fintechs use non-traditional data like social media or mobile payments to assess risk, making credit more accessible. Next, liquidity. Banks follow strict lending and reserve rules. Fintechs enable instant payment, making transactions are more fluid. Next, risk management. Banks stick to conservative models. Fintechs use AI to predict defaults, which is innovative but less tested in economic downturns. And lastly, trust and regulations. Banks are trusted due to regulation and insurance. Fintechs rely on user review, transparency, and app experience to build trust. Finally, let's talk about risk. First, cybersecurity. Banks store huge volumes of data and invest billions in protection, but some systems are outdated. Fintechs use newer cloud-based security, but rapid growth often leaves vulnerabilities. Next, credit risk. Banks are conservative in lending. Fintechs accept more risk using AI and alternative data, which can increase default rates. Next, operational risk. Banks face issues like paperwork delays. Fintech deals with bugs, crashes, and tech failures, especially if they rely heavily on third-party providers. And lastly, emerging risk. Fintech face challenges like AI black box, where decisions aren't transparent, vendor dependence, and reputational risk. One glitch can damage user trust significantly.
In conclusion, the financial industry today is shaped by two powerful forces, which is commercial banks and fintech companies. Commercial banks have existed for a long time and are trusted by the public for handling saving, loans, and secure transactions. They are known for their strong regulation, physical branch, and professional service. However, to remain competitive, banks are now improving their online systems and mobile apps to meet the growing demand for faster, more digital banking. On the other hand, fintech companies are becoming more popular, especially among the younger generation. They offer modern and easy-to-use platform for making payments, transferring money, and even investing, all through smartphones or websites. These services are often faster, cheaper, and more convenient than traditional banks. Many fintech firms are also starting to provide bigger financial services like personal loan, insurance, and digital wallets. In the future, it's likely that both bank and fintech will continue to grow and possibly work together. The competition between them is a good thing because it pushes both to improve the service for customer instead of one side winning over the others. The best outcome would be a system where bank offer trust and safety while fintech provides speed and innovations. This partnership can help create a better, more modern and more exclusive financial system for everyone. That's all.